Have you ever wondered whether the investment you're making in real estate is going to give you returns at all? You heard a lot of financial influencers telling you that it's better to invest in the stock market and in mutual funds versus real estate because they give you better returns, and real estate depreciates because it's an apartment. I'm Ashish Acharya. I'm the founder of Propsoch. We help homebuyers make intelligent decisions as they go about making the biggest investment of their lives. Today, what I'm going to walk you through is a financial model which we have built in-house to kind of show you the different scenarios and what kind of returns you can expect when you make investments in real estate. So in this sheet, I'm going to walk you through the various inputs that are required for the calculator to work and give you an output which makes sense to you. So as you can see, we start off, of course, with the purchase price. What is the quantum of investment which is going into the particular property? So if you're looking to buy a 1500 square feet property and the price is 10,000 rupees a square foot, that's effectively a price of 1.5 crores for the property, right? Typically, an average home buyer takes a home loan in the range of 80 to 90% of the property value. For the sake of this example, I'm assuming it's 90%, right? The average interest rate is going to be around 7.7 to 7.8%, and the loan tenure which you can maximum avail is around 30 years, okay? Again, it depends on your age, it depends on the financial institution, it depends on your earnings, but I'm just taking scenarios which are very prevalent and what we are seeing with most of our customers. So the project completion quarter, this is the quarter in which the project is slated to get completed. So here I'm assuming a property which is a newly launched property which is going to take 3 years to get completed, which is 12 quarters. The exit quarter, this is the quarter in which you want to exit that investment. Like I said, this is very important on when you exit your investment because this could make or break your returns. So here we have taken an exit quarter of 20 quarters. To simplify this, we are going to assume an exit of 11 quarters, which is just a quarter before the project is completed. This is what typically a lot of smart investors do. Then we are going to talk about the rental yields. Rental yields are nothing but if you decide to hold on to the property after completion and rent it out, the typical rental yield in a city like Bangalore is in the range of 3 to 4%. I've taken an average of 3.5%. The rental escalation which you can expect of 5%. The stamp duty, which is around 7.6% today in Bangalore, and the interiors cost, which is typically 8% of the property value for a pretty good job from interiors perspective. Then we are going to move on to other fees and brokerages which are applicable when you try to sell the property. If you're selling the property before it is completed, you will probably have to pay a 1% transfer fee to the developer, and you will have to pay 2% brokerage if there's a broker involved in the transaction. Then there are 3 scenarios with respect to CAGRs, which is nothing but the potential price appreciation that you expect on a year-on-year basis, right? So we have taken a pessimistic scenario, a realistic one, and an optimistic scenario. There's a huge range between these scenarios from 7 to 12%, right? So when you put in these inputs, you start looking at what kind of outputs are coming out. So firstly, the EMI on the project getting completed and on the whole loan being availed is going to be approximately 2.89 lakhs per quarter, right? So that's approximately 90,000 rupees a month. And the exit price, if you take a realistic scenario of 9% price appreciation in 11 quarters, you're going to get an exit price of around 1.9 crores for the property, right? So here's the interesting thing. The initial property value was 1.5 crores, but you technically did not invest 1.5 crores. What did you invest? You invested only 10% of 1.5 crores, which is 15 lakhs. The rest of the investment was funded by the bank, right? So when the property value is 1.5 crores and when you're exiting at 11 quarters, it's going to be around 1.9 crores, okay? Now let's talk about the payment plan. Not ideally, but it should always be a total of 100 because this is the way in which you're going to be paying the developer for the property. So for simplicity's sake, we have created 2 scenarios, a 3-year plan for apartments, and if it's a plotted, there's a 2-year plan. So in this case, we are going to be talking about apartments. So let's just take the 3-year plan and put it down here. Great. So now the total of the payment plan is 100% and all the inputs are in place. So what kind of returns could you expect because of this particular investment? Think about a number in your mind and let me shock you about what the actual returns could be. Let's go to the output sheet. So what we're looking at is basically different financial metrics which you can use to figure out whether the investment you made makes sense or not. The first metric which you're using is something called leveraged IRR, or internal rate of return. This is used by most of the financial professionals when they want to consider whether an investment they have to make makes sense or not, right? IRR is kind of equivalent to the amount of returns you would make if you put your money in an FD and you made, say, 7% returns on an annual basis. But effectively, as the FD compounds over a period of time and you calculated the returns, if you put in 100 rupees and you finally got 200 rupees, your IRR will slightly be higher than 7%, right? Because there is a compounding effect to it. That's a very simplistic explanation of IRR, but I think that should do for what I'm going to explain to you now. So based on the various assumptions that you have put in the most realistic scenario, you would make 50% of returns on your investment. Keep in mind your investment is not 1.5 crores, it is the 10% of 1.5 crores, which is 15 lakhs. But there is another element to your investment. Do you know what that is? It is your pre-EMIs which you have paid towards the loan, right? So while you have borrowed the loan, there was an interest meter which kept ticking and which you kept paying on a monthly basis or a quarterly basis. And this interest keeps increasing as you keep taking more and more loan. So effectively, by the end of the project, when you are about to sell it, right, you have paid an interest of approximately, by the end of the project, this is the amount of interest that you have paid, which is around 10,68,000 rupees as your interest. So this is your total investment, the initial 15 lakhs and this 10 lakhs over a period of time, right? And that's why we calculate all returns in terms of IRR, right? So if that was your investment, the kind of returns that you have made is approximately 50%, which honestly is far better than any of the other financial instruments that you might have been investing in. And do you know why this is happening? Because unlike a mutual fund or unlike a equity investment where you cannot get a loan to invest in the market unless you're taking a personal loan at very high interest rates, here you're borrowing from a bank at 7.7%, which is probably the lowest form of debt which you can raise. And you're leveraging that in a market where the prices are going up and you're making an amazing return on your investment. So your equity multiple is nothing but if you put in that 15 lakhs and you put in money in between and your final profit at the end of the exit was 31 lakhs, right? Your equity multiple on your initial investment is 2.2 times, right? And that is exactly how you need to look at it. You might argue that, hey, I bought the apartment for 1.5 crores and I sold it for 1.9 crores. So how can it be 2x, right? Because this is a multiple on your investment, not on the total apartment value. I keep emphasizing this because this is the most common mistake that people make in their financial calculations when it comes to real estate. The actual selling price divided by the purchase rate is 1.27 times, right? This is more for information, but it doesn't mean much because your real returns are being made at this 2.2 multiple. Right? So now if you look at a pessimistic scenario, you're making 26%, and if it's optimistic scenario, you're making a 59% return on your investment. Now this seems too good to be true, and probably it is. So we probably need to look at a scenario where you're going to be exiting the investment after 20 quarters, which is approximately 5 years from when you make the investment, right? So what happens to the output? So your output drops. Right, so not all the financial investors were wrong, that there is a certain reason that if you hold real estate for a longer time, the return on your investment decreases, right? But this is your IRR which is decreasing. So if you look at your absolute profits, you're making 43.6 lakhs, whereas the earlier profit which you're making was around 30 lakhs, right? So in absolute terms, you're making more money, but if you look at the return on your investment, you're making probably lesser money. But still, this is a very healthy return compared to FDs and probably an average of how Sensex has performed in the last 12 months, right? So where can all these calculations go wrong? And am I just selling you a rosy picture? Absolutely not. Suppose the market takes a hit, right? Suppose the market, and that's actually the pessimistic scenario, but let's be more pessimistic. Let's assume the prices only appreciate by 4% per annum, right? So what happens to your returns? Then you look at a negative IRR of 8%, right? And you on your equity which you have invested, you are only getting 0.79 times. Basically, you made a loss of around 13 lakh rupees. So you need to figure out where to invest, what is the timing, what is the growth appreciation, and all these inputs you can only get if you study what's happening in the market, what are the price trends, what are the infrastructure developments, and what are the commercial activities which are happening there, because that is what defines the growth rate of a particular property's price. So coming back to the input sheet, right? At a 4% scenario, you're losing money on this real estate investment. But suppose you still sold it in the 11th quarter instead of the 20th quarter, are you still losing money? Let's look at the output. Not really, but you're neither making a massive gain, you're just making a notional gain of 69,000 rupees. So it's still not a great bet. So if you feel that a particular market is not going to be appreciating more than 6, 7, 8% per annum, then it's probably not the right place to be investing, right? Now let's look at another scenario. Actually, so why is there a huge change in the return profile if you choose to sell it after a longer period of time versus just before completion? There are two main elements which come into play. One is the stamp duty that you pay. In Karnataka, you do not have to pay your stamp duty when you book the apartment. You have to pay the stamp duty on completion of the project. So this 8% cash outflow which is happening is going to add to your investment at that point in time, or the amount of loan that you're taking. The second thing which comes into play is this 8% interiors cost. In our model, we have assumed that you are bearing these two costs and it's not a part of the home loan, right? But there are ways in which you can make this also a part of your home loan, which will further improve your returns. But to operate at a conservative level, we are not including it as a loan. So when these two elements come into play, these are substantial investments which are happening, and we have modeled it here. So let me just make this 20 quarters again. So you see here there's a 23 lakh outflow towards stamp duty and registration in the quarter when the property is getting completed. That is the 12th quarter. Another interesting thing to note here is from here your regular EMI starts, okay, because till now you are only paying your pre-EMI, which is interest, but after the property is completed you have started paying your EMI, which is a fixed number, right? But you're also earning a rental income of 3.5% per annum, right? And on a quarterly basis, you're getting around 1.31 lakhs. This is a inflow to you. So this reduces your total outflow. EMI minus your rental income is a negative number of minus 1,57,000. So the model has been designed on these parameters. Of course, when you sell the property, there's a brokerage which you have to pay. But interestingly, which I should have done earlier, you do not pay a transfer fee once the project is complete. So your outflow towards selling your property towards the end is only the brokerage and nothing else, right? So in this way, you can actually go about figuring out what kind of returns you can make from your potential property investment. But be careful, this is still just an Excel model, it's just a financial calculator. There are a lot of real world scenarios which go into defining whether all these inputs which you have taken into consideration are going to hold true or not. Suppose a developer delays a project, right? Then your timelines are gone for a toss. Suppose a developer has a very aggressive payment plan. Instead of taking 20% now, he takes 40%, right? And then he doesn't take money towards the end of the project. Then your returns again drop. Because you're paying more money upfront, your pre-EMI interest is also going up. Like that, there are various scenarios with which you can play around in this model, and you will be able to figure out what is the sweet spot for your investment. At Propsoch, we have refined this whole process to make it easy because we know you are all busy professionals. You might have the inclination but not the time to build a model like this and run through it. So our professionals will help you figure out what is the right CAGR to assume, what are the right inputs to assume, and run it on a model and tell you what kind of outputs you can expect when you decide to exit a particular investment. I do hope you found this useful, and feel free to connect with our experts at propsoch.com if you need access to this calculator and be part of our home buying journey.